Gold price has climbed almost 10% since the Brexit vote on June 23rd, but has given back about half those gains in that time. My guest today says, don't worry if the Brexit-fueled rally is already over. He says, in the long term, gold is a phenomenal place to keep wealth. Joining us to give us his perspective, Thomas George. He's portfolio manager for the TD Precious Metals Fund and the TD Resource Fund, and a frequent guest. Great to see you.
Yeah, nice to be here, always.
Okay, let's start off with the 1 month on gold, just to talk a bit about what's happened. And again, we saw the rally with Brexit. We saw then, of course, the fall off. Everything's going to be fine rally.
I'm still skeptical.
Okay, well, why are you skeptical?
I still think we still need to figure out what the impact of Brexit is. A lot of the rally was partly fueled by just the view that there's going to be more quantitative easing. There's going to be more potential helicopter money. Like these are signs of a very, very deflated economy. Yeah. So part of me just feels like to let the equities rally prior to all this.
Well, let me ask you, because when you talk about this, and I've seen the notes that you've sent out, you call gold the ultimate financial insurance.
Yeah, so we take insurance for life insurance, car insurance. The reason we do is that I'm a good driver, I would like to think, but sometimes something bad happens, right? Yeah. And there's that low probability. So just like that in your financial portfolio, you have a mix of assets, but you do need sometimes to have a little bit of insurance, something that's uncorrelated with the other assets, and something specifically when equities go down, goes up.
But it's funny, because if you look, is it as uncorrelated as it was? Is it still moving in opposite directions?
Oh, with equities, absolutely.
Yeah.
So if you look back to 1987, every major market correction we've seen since 1987, gold has outperformed meaningfully, like in the order of 50+% relative to U.S. equities. So from our perspective, it's actually fitting that role in spades.
I want to talk a bit about just some of the pullbacks, because I know, it's funny, if people tune in to BNN during the day, a lot of people are saying, okay, we're kind of topped out of gold right now. We've gone as far as we're going to go. Why do you think I can't ask you why they're saying that, but why do you disagree with that?
Yeah, so I think a lot of investors get caught in near-termism.
Yeah, because it's had a good run.
It's had a phenomenal run, but you have to really think about the fundamentals of the metal and say, are they still there? Has it run away from the fundamentals? And from our perspective, it's fitting the role it's supposed to. It's telling us right now we know real yields are the critical driver for gold. And where real yields stand today, there's more upside in gold. And so from our perspective, we're seeing a world of negative yields, where nominal yields are negative, where real yields are negative. So once you strip away inflation from all bonds, you've got nothing. So as a gold investor, the best time to be an investor is when you don't have other places to park the money.
Right. So just the opportunity cost is just not there.
Exactly.
Let me ask. We asked you to kind of put a few things together in terms of why to support your thesis and why gold is the ultimate financial insurance. Let's take a look at this. You got a chart here that demonstrates, I'll say, income inequality, and we're looking at I think the percentage of U.S. aggregate household income we're going to pull up. Why is this chart important? Why does this matter to gold?
Oh, this is a chart that explains a lot of why we are where we are today. It can explain Brexit. Same dynamics hold for the U.S. This is the U.S., but same dynamics hold in the U.K. And it explains a lot of the, I would just say, angst in the U.S. voter population. Just the divisiveness, right? And so what this chart shows is it's by income type. So let's call that middle class, the middle income. Back in 1970, that represented 62% of total aggregate household wealth in America. That's a good place to be. When middle class has money, that's always a good sign for the economy. Now you fast forward to 2014, that proportion of the middle class has now dropped to 43%, whereas the upper income, twice the median salary, or above twice the median salary, has risen from 29 to 49. So from our perspective, there's a real story here, and this income inequality is a real challenge for America. Because from our perspective, it's not just a challenge for America; it's a challenge for the broad developed world, and we think this is really the challenge. There's disenfranchised voters who in the U.S., that middle class has not seen their income rise since 2000. They've actually seen it fall by 9%.
So spell this out to me like I'm 3 years old.
Yeah.
So you have disenfranchisement, you have income inequality. Again, take me to the link to gold.
Yeah, so the link to gold is very, very, very real. So the challenge right now, it all comes back to monetary policy.
Right.
You know, how do we make this all work? You have a whole class of citizen in the U.S. that has lost their their manufacturing jobs and now are working retail. And the problem is it's just really the link is to the global economy. It's just we are in an anemic growth environment, and we're topped out in debt. So from a global growth perspective, there's nowhere else to go. So from tying this all back to yields have to remain low, if not extremely low, below zero, to keep this, to keep at least some juice in the economic system. And that juice, in our view, still is not going to be a whole lot.
Which again is that is the fertilized bed, I guess, for gold prices to keep on
That's
going.
right.
Let's now talk about a chart on 10-year. We've got a look at 10-year U.S. real yields and what's been going on. And I know, again, if I talk to enough of fixed income people, which I seem to talk to a lot of lately, 1/3 of all debt in the world is negative yields.
Right, that's right. And this is kind of, part and parcel of the issue, right? So this is the fundamental thesis behind gold. This is really it, right? This is that opportunity cost we were talking about earlier. And this is, so what this graph is really showing, you're taking the 10-year nominal U.S. Treasury, the bond, and subtracting inflation. What you can see, and so it's effectively the real return you get on that bond.
The one thing I would say though is inflation is so low that when you subtract it, I mean, your actual and real are actually pretty close.
Yeah, that's a great point, right?
Yeah.
So, sorry, when inflation and nominal are so close,
Correct, thank
right?
you.
So when you strip away inflation, you're left with nothing, right?
Yeah.
So that's kind of the situation we're in today, and that's the challenge, right?
Yeah.
So if we look at, you were getting a reasonable return back in 2000, 4% real. That sounds actually reasonable.
Yeah.
At stripping away inflation. Today we were just at minus 10 basis points. Today we're at plus 10 basis points. So this is the kind of environment we are in today. And so if you think about that, and we're going to show a chart later on explaining how that then we throw that into a model and just really try to understand where we can price. From our perspective, this is a very intriguing time. And that 10-year U.S. So a lot of people come.
Well, let's bring it up here. I'm going to tell the control room, but no secrets here. You can see how it all works. But we're going to bring up the chart with gold and the gold price implied by the U.S. 10-year real rate. So taking the double line on the graph, you'll see what that 10 years is saying, where gold should be based on past performance.
So what this is showing is the gold is the orange line there, and the gold price implied by the U.S. 10-year real rate. So effectively, when you tell me where the U.S. 10-year real rate is, I can tell you more or less gold should trade around this level.
And what you want to show is it's been a fairly true relationship. It's been a little wonky, I'd say, between 2002 2006. But
and there's real reasons behind that. But what we can say is, like, over the last 5 years, it's been spot on. And so right now, the U.S. 10-year real yield is at 10 basis points. And that means that the implied gold price should be $13.40. And today, we're at something like $13.17. So very close. And so that's the critical point here. In our view, this real yield continues to grind lower. We've already this year seen minus 10 basis points. I think we get to minus 50 basis points, and that should drive out a gold target for 15.30.
Really? Okay, let's take a look at that. We'll just kind of sit with that one for a second. You've got a chart here showing changes in gold ETF holdings. Why are we looking at this?
Yeah, so this is a critical one. So when we think about this insurance policy, I think it's important. This is a case of what is the smart money doing? So these are all the gold bullion ETFs, their holdings aggregated. Then what we look at is on a 3-month basis, so a rolling 3-month basis, when do we see significant moves? And those significant moves are driven by large institutional investors, large global asset managers. So when you see a move in excess of 300 tons, which we saw back in February 2009, and then we saw more than minus 300 tons in April 2013, we say that's actually a very interesting point. Let's now look at the returns 3 years from that, based on that 300 tons. So what you see here is if you use that as an indicator, February 2009, this mass buying of gold, over the next 3 years, gold returned 83%. Now, if you look at April 2013, in excess of 400, over the next 3 years, your return was minus 12%. So at the end of March was the first time we've seen 300 tons. To date, we're at something like 7.5%. Gold has been up. So all we're saying is that there's a lot of smart money out there. When they say it's time for insurance, it's historically been proven that that's actually been a very good bet.
Here's a question for you. Argue against yourself.
Yeah, I
I
do
know.
it all the time.
Yeah, really. Why would these theses not come to bear?
Yeah, so I think the critical risk here globally is the U.S. It's the only economy that is semi.
So if it gets traction, if it gets going.
If it gets traction and Yellen decides to push up the front end, which is the front end.
Which the market is starting to price that in.
Exactly. So, but that's critically, we have to say that's the front end. But if the bond market and the bond market really decides the whole thing, if they decide, yeah, you know what, there actually could be some growth, there actually could be some inflation. The yield that we need on this 10-year Treasury is not supposed to be 1.4%. It should be something like 2, 3, 4. And in that market where real yields go up, absolutely, that's an environment where gold can fall. The only caveat I'd say, and this is kind of me arguing against myself, I will say, well, you know what? Coming back to that whole third of bonds globally are negative. Yeah. What does a German do? Yeah. He's going to see that. So the 10-year,
the money goes into the 10-year, pushes the yield
yield down, and the U.S. market is so large that it's really a core asset for global asset managers.
Yeah. Okay, that was a good argument on both sides. So, and if real rates right now, I'm sorry, where the real 10-year
is plus 10 basis
plus 10.
points.
So if it went up to 1, just humor me, what would that mean for gold prices then?
So if it went up to 1, the gold price would fall meaningfully, right? Okay. So it's kind of it'd fall in excess of $100.
Always educational. Thomas, thank you.
Thank you.
Thomas George, he's portfolio manager with TD Precious Metal Fund at the TD Resource Fund. I'm Kim Parley. Thank you so much for joining us tonight.